Good afternoon, everyone. I'm Curt Strubhar with Advanced Trading, joined today by research analyst Brian Basting and senior broker Nate Durako. And we're here primarily to talk about today's USDA WASDE report, which came out at 11 a.m. And we'll just start with a little Q&A conversation. Brian, let's have you kick it off. So the May WASDE is the first official USDA look at new crop balance sheets. But let's start by focusing on the old crop a little bit. We saw pretty minimal wheat changes, but saw exports increased for both corn and soybeans. Can you give us a little bit of an overview of those changes and maybe any color behind what the USDA was looking at?
If you look at that old crop balance sheet, particularly for corn, Curt, we are the primary shop in town around the world right now for corn. We had the smaller crops last year in Brazil, smaller crops last year in Ukraine. And as this crop year winds down, we're finding out they don't have much left to offer. And so what we're seeing now is if you need corn near term, come to the U.S. So the U.S. has acknowledged these aggressive sales we've seen recently, and they've been very universal. Not only our traditional customers, Mexico, for example, but Europe, Curt, is coming here and bought a lot of corn, relatively speaking, compared to recent years. So that number seems pretty solid to me as this crop year really begins to wind down here. I don't see that changing. The only wild card there, Curt, may be if the Brazilian crop comes off early. Maybe they might be able to nudge in there in late July and August, but I don't read that much into that. I think that the U.S. is still going to be in the driver's seat, as it will, for the next 3 months. The big question, as you look at beans, Curt, is what's going to be the fate of the unknown book and the export sales report? If those sales are going to find a home, i.e., for example, to China, as this crop year winds down, I think that increase is justified because we're seeing good demand from Africa, seeing good demand from Europe. A lot of those places have really stepped in here. It's a bit surprising given the volume of Brazil's crop, up over 500 million bushel from last year. But having said that, the demand is there for beans. It's not as strong as corn, but I would support both those estimates as being legitimate today. The big wild cards would be, again, what are we going to see in that unknown category in beans? And would Brazil get the new crop off early? I don't read too much of the new crop and beans, but I do think Brazil could be a big competitor for new crop this fall.
For new crop, for that window. Sure. Good. So those were the most notable changes on the old crop balance sheet. I did want to ask just a little bit on the old crop corn side of things. That increase in exports puts the USDA pretty close to what the Advanced Trading Research Group had been using for corn. So I'll give you a little credit for that. But there's still a difference in our balance sheet and the USDA, and it's primarily on the feed and residual figure. Can you give a little color on that and then expand a little bit into when will we see whether our lower usage figure is more accurate or if the USDA is in line with what they're showing today?
You got your finger on the pulse of the $64,000 question, as it were, Curt, because we only get the grain stocks report 4 times a year. Last time we got it was at the end of March. We're not going to get an update on grain stocks until the end of February, end of June 30th. So that's 45 days away. We're going to be looking at that number and saying, is it too high? Is it too low? The big difference or big divergence, I should say, between Advanced Trading and USDA is the balance of the year numbers. We've only got a feed estimate, Curt, for the first 6 months of the crop year. We won't get the third quarter estimate until the end of June. And we won't get the fourth quarter estimate until the end of September. So when we look at that first half of the year disappearance, Curt, on corn feed residual implied, to reach the USDA number, we really have to have a stout number, not only for the third quarter, but also for the fourth quarter. And I think one thing that we may be seeing this summer now with the wheat market here declining again today and the wheat corn spread continuing to look possibly at some more increased wheat feeding this summer. Not a robust wheat feeding program. I don't want to give that impression. But point being is there going to be some wheat feeding this summer. And it looks like that could slice into that corn share. So bottom line, Curt, the BOI, balance of the year usage numbers from USDA and our standpoint imply a very aggressive 6-month feeding. And we just don't agree with that today. We'll see how it shakes out. June 30th is the number we'll get from USDA. Of course, it'll be in the middle of the growing season, but that'll be a little nugget we can look at in the grain stocks report.
Sure, absolutely.
Might be a quality play too on some of the wheat, especially SRW, as we've seen some continued rainfall across that market or that production. And wheat and corn and what feeds best, feels like today price points, we've got the availability of corn. Wheat keeps trying to find its way into that ration. It may be some quality specs too that force a little more wheat feeding Southeast market. So we'll see where it comes in final.
Absolutely. That's a great point. And you mentioned June 30th being kind of the middle of the growing season. It's also, I believe, first notice day for the July corn contract. And we're staring down at an inverse, less than where it would have been 10 days ago, but a fairly steep inverse. So a lot of info coming together right at the front end of the July deliveries there. Let's shift a little bit towards the new crop end of the report releases today. And I'll kick it over to you, Nate, and just a couple of prelude questions before I let you ring in. The market knows that it's USDA's practice to use what they call the February Outlook Forum for yield figures for the corn and the soybean production, and then the March 31 planting intentions report for acreage. So in that sense, the supply number printed today for new crop balance sheets wasn't a surprise at all to the market. My question is more on what you're seeing in reality. By definition, planting intentions are what farmers think they're going to do. In last Monday's report, this will be updated today, but in last Monday's report, the USDA showed us 40% planting completion on corn and 30% on soybeans. You talked to a wide range of geographies and in terms of your client base. What are you hearing? Are the acreage figures by the USDA in line, or are you hearing a big divergence in a given region?
I feel generally they're in line. Divergence, I would argue, maybe counter to that, except for some, I still think there's some optimism on increased corn acres, just considering the planting pace we've seen. Like you said, we're 40% on corn, 30% last week. Average, I think, is around 56 that we'll see this afternoon, with some estimates in the low 60s. We've had a really nice window of planting. Central West, then got some rains. Eastern Corn Belt, still getting some rains, but I think making some timely progress. And nobody really stands out as behind average. There's obviously some pockets, Southern Illinois, parts of the Mid-South that have been getting some rains, but their progress was noted, average or ahead. So I still think, within the advanced trading deck of customers, the ones we talk to, there's probably still some optimism on higher corn acres. And I'm not sure we're seeing a big weather issue that would make me want to guess against that, at least not to a downside at this point. Beans, a little argument, the economics really favored, which is one of those drivers, maybe seeing an uptick in the final corn acre number. And I think weather permitting today, there's not a lot of issues that I would say would counter that progression.
Excellent. Thank you. So I use the phrase a lot that the projecting yield in early May is really a paper exercise, right? We can print what we think on the yield perspective, but it's a story largely still to be told. So my question is that the USDA uses their trend line figures for corn and for soybeans. And we've had some marketplace users that have started to question a little bit the trend line increase in corn year over year. Are they starting to get too aggressive from that perspective? And I guess from an action standpoint, the real question is, should a consumer of grain, a buyer of corn, be a little concerned that, hey, this balance sheet is using a 182 yield? That's not really realistic. And if I drop that by 4 bushels per acre, now it looks a lot tighter. Any commentary on that? And if you want, you can ring in a little bit just on summer outlook and what our growing conditions are at the moment.
Sure. And it's a great question. And I think we've talked a little bit in these conversations and a lot of our data that we push out on. It's harder and harder to achieve trend, but if you believe in trend, I don't know that there's a reason to argue against that, right? And maybe I'll let an economist jump in a little bit more with detail there, but for the most part, I don't feel like we've pushed the limit on the upside. A perfect growing season across space, farmers putting money into the crop. Maybe there's some arguments against that this year with the economics and summer weather outlook, like you noted, to be determined. Some potential drought and expansion of that in the West and how that could impact yields. Variables we trade every year. Today, though, I don't feel like there's a strong argument to say, well, let's just go in and say we're not going to achieve trend and guess against that. And then from a macro picture, big picture, the increase in South American production outlook and Ukraine as farming practices change, GMO policies, non-GMO grain, whatever the outlook is there, feels like the world supply can continue to grow, even if we maybe plateau from a perspective on U.S. yield. And the other point I'd make from, just a bias of, is this something that I need to trade from an aggressive price move? I don't think so today.
Mhm.
Weather permitting, I don't want to argue against it, like I said. And really, at the end of the day, we probably have a little cushion. I'm not front running the export question here, but pretty strong demand put in the new crop balance sheet today. And so if we were coming in on a 1.3, 1.4 carryout like we are, and 90 million acres of corn, maybe there'd be a little bit more price risk or production risk priced into where the market outlook is today. But some of the upside in the world supply too, I think it's a tough stance to make today that we should be outguessing that USDA yield, I guess.
Sure. Well
I'd
stated.
blend a little bit into Nate's comments there. He made some really good points, Curt. And I think it comes back to the ATI philosophy, trusted risk management. It applies not only to producers, but it applies to the end users too. And in this sense, you made a good point, Curt. The end user can make a point and say, well, if we are going to look at a 177, 178 yield, there is upside risk to my operation. So, but I want to give myself maximum flexibility. One possible strategy, buy a call option. Call option gives you that unlimited upside protection, but also gives you unlimited gives you upside protection, but also gives you unlimited downside opportunity if the market were to fall apart. If we were to get, as Nate said, a 182, 183 yield, who knows? And the size of the increase in Brazil, you could really talk both sides very easily today. And Nate made a good point. We are not looking at a 90 million acre number. It sure feels like we're going to get at least 95 million. So as an end user, I think trusted risk management, work with somebody you believe in, work with somebody whose philosophy is consistent with yours. And in this case, it gives that upside opportunity or upside protection, but also gives you the downside opportunity if the market were to fall apart, let's say into harvest.
Absolutely. That's well said. Options work best when there's market uncertainty, and
you
there's
bet.
certainly uncertainty from a new crop perspective. Let's shift back and talk about export demand, but let's kick it to the new crop side now. And you talked, Brian, about the U.S. kind of being the only shop in town and reasons for growth on the old crop corn, specifically export front. USDA also bumped up exports for, I shouldn't say bumped up, released a fairly aggressive new crop export figure for both corn and soybeans. From that perspective, were those the biggest surprises in today's report? And is there much color behind that drive, that kind of an increase when we've got a large Brazilian crop coming off here in 3 months?
I would agree with you, Curt, that was probably the biggest surprise in the report when they printed that export number for new crop corn. When we're looking at the magnitude of the increase in Brazil, which is that crop is making it safely for the most part through pollination. It's not safely through growing season. You could have a freeze in the south, for example. But if you believe that 130 number that the USDA printed today is going to be realized, maybe higher, and you're looking at Ukraine's crop being bigger this fall than it was a year ago, Argentina's crop being a tad bigger. That's you add in all the principal competitors with the U.S. projected to grow 13 million more tons. That's over 500 million bushel. Now it's grow, it's not export, because we are seeing some domestic use increases, for example, in Brazil.
Mm-hmm.
So, but having said all that, I think that number sure seems aggressive at this point. The one wild card we got to talk about, Curt, is China. And we're just in the infancy stage, perhaps, of these trade talks, obviously a 90-day pause now with the tariffs being decreased substantially from what they were on both sides. Boy, if you start penciling in China into the equation, or something similar to what we saw 6-7 years ago, whenever the phase one agreement was reached, my point is there you have a wild card that could definitely be supportive, for lack of a better word, of that number. That number today by itself, excluding China, seems a bit aggressive. So what I would suggest briefly here, Curt, from a producer standpoint, using the same philosophy that I highlighted just a moment ago for the end user, the producer is saying, well, we're going to only have a 1.8 carry out for 25, 26. There's a lot of what ifs in that scenario for 25, 26. And one of them would be if that export number is, take 200 or 300 off that export number, all of a sudden you looked at 2 billion bushel carryout. So I would just be cautious, strictly looking at the fundamentals and setting aside weather for the moment. If we were to get a rally on this new crop corn, for example, discipline, manage price risk, avoid price prediction. Not only goes for corn, but also goes for beans, Curt.
Certainly.
I think that magnitude of that Brazilian crop that they've already put in the bin, the Brazilian crop's in the bin. If China were to come in here again, maybe the 25, 26 bean export number is realized, but I'd be cautious on the 25, 26 bean export number too, and looking at that 25, 26 risk management strategy if I'm putting beans in the ground at the moment.
Right. Absolutely. Well said. And to shift to focus maybe a little more on the bean side, you mentioned how the Brazilian crop is already in the bin. You know, exports have started to be a little more aggressive there. From a dynamic standpoint on the soybeans, and I'll throw this one to you, Nate. What's left to change? You know, the old crop global balance sheet, pretty minimal. We obviously have U.S. production to get through, but what are we watching from a market observer standpoint on soybeans right now, where the story seems a little more muted compared to corn?
Yeah, playing off a little bit of what Brian said too, just, and Curt, the way you started it, right? We're kind of used to seeing that Feb outlook be the base points for the production. And everybody was watching the demand figures today, knowing, are they going to take current tariff situation and assume we're going to be price uncompetitive in the world market to China, basically. You know, they threw China in for corn for a second on 10 million metric ton for the 25 import forecast. Pretty conservative number, where I would have thought if they were projecting higher for US, it would have implied maybe a little more Chinese demand. That is, it's been a slow pace this year. To your question on the beans, it's interesting as well when you talk about the Chinese economy, the pace we've seen them buying world beans this year. Yes, it's picked up from as Brazil's harvest came online, but market commentary, and we saw a slight reduction in the old crop, I believe, today on the Chinese imports. Maybe it was unchanged, but a lot of year over year growth for 25, 26 assumed flat, I think, more by the trade. Yet they went to 112 million metric ton soybean import for 25, 26. So you're implying either some better demand over there, increased crush margin, increased meal demand. And ultimately, I think the trade is probably leaning a little more conservative on that demand without a trade deal. So the uncertainty of, did USDA imply some optimism from a trade deal? I'm not sure the answer of that. I think from a global perspective, like we noted, big South American crop, Argentine producer really starting to engage as their harvest progresses. We're seeing that implied in South American meal and oil values that are competitive with the U.S. And then I think a big unknown domestically here, whether or not our exports on beans are going to flow that way, is biofuel policy. And what we see ultimately for our domestic crusher, as that demand capacity has expanded, are we going to see that shift, continue to a positive margin, whether it's the RVO or 45Z policy that drives that demand a little bit more than what we've seen kind of stagnant here as the start of the 25 calendar year, especially.
Yeah, that's a question I was going to get to with you. So we'll actually stay with you here for just a minute, Nate. On that end, the USDA had originally forecast a pretty good increase in soybean oil usage for biofuel for the current marketing year, 24-25. In today's report, they knocked that down a little bit, but for their first print of the 25-26 balance sheet, they ramped that number right back up. Yeah. Fairly aggressive year-on-year growth. You talked about the policy changes and the policy uncertainty, so it would be unfair to ask you to predict policy, but are we at some risk of overproducing soybean oil again, kind of like we started to get into this year, and at risk of being a threat to soybean crushing margins? Or do you feel like the industry still has enough growth and enough potential to alleviate that concern?
It's a great question. I think there's a lot of unknowns in it. I think at the end of the day, if soybean oil is competitive into renewable diesel, biodiesel, the capacity obviously that we've increased in the U.S. is going to be there to feed at least what we feel like the optimism on an RVO will be for 25, 26 and 26, 27. I think there's been a lot of changes as policy uncertainty from the USDA. we talk about 24, 25 for a minute here. In the April WASDE, they increased exports 500 million pounds and decreased domestic use both in biodiesel and food. And then today, they continue to ramp up exports and see that domestic demand reduction. And it feels like there's a little bit of a flip as we talk about the availability in the South American soybean supply and the ramp up in their crushing to try to meet some of that oil and meal demand as well. Products are just heavy right now. And so it feels like they're shifting a lot of the U.S. demand and maybe not accounting as much for what the world supply of soybeans is that's going to compete with those crush products. Most crushers today, as we've seen a downtick in margins, still talk about difficulty finding depth in meal and oil demand. We've seen pretty heavy deliveries, at least the last 2 option months for meal and oil. So it feels like supply is there. And if we continue the trend that we've seen at the start of the calendar year I think we only had maybe 3 months of census data out for Jan, Feb, March, and seeing that reduction in soy oil use, actually UCO taking over from a perspective of volume, it's hard to, it feels like we have still some potential growth in our ending stocks on oil and meal current marketing year and some headwinds into new crops. So maybe a little optimistic on that uptick.
Sure.
Unless, they're driving a little more clarity in policy. I mean, I think these new plants are going to run. I think we're going to have available oil. Ultimately, maybe the same comment they kind of made on the corn balance sheet that low prices cure low prices essentially. We'll find some additional demand, but I think it's going to feels heavy today without some clarity on policy.
Sure. Good stuff. Good stuff. Brian, let's make sure we give wheat some attention. The USDA's new crop ending stocks were up about 80 million bushels from the current marketing year that we're about to conclude. You talked a little bit about wheat trying to work its way into a feed ration here in the U.S. In addition to the growth in U.S. ending stocks, the global stocks took a jump as well year on year. What's out there that could be a dynamic to shift wheat from looking as burdensome as it did on the surface in today's figures?
I think probably the top of the list, Curt, is what is Russia going to do with their export, basically their export policy as this 25-26 crop year gets underway. Right now, it looks like that they're looking at the crop a little bit bigger than last year. Now that crop's not in the bin by any means, and the spring wheat is a long way to go. But if you look at the USDA's estimate today and take that at face value, I could say that Russia will continue to be an export force. The wild card would be if that production number pulls back, then we're looking at a much different picture. Does Russia really pull in their export forecast for 25-26 export intentions, I should say? So that'd be the top of the list. What's going to happen with Russia? I had added Black Sea, Ukraine into that mix too. The whole Russia-Ukraine situation right now is fluid, needless to say. So that's the top of the list. If that were to really both deteriorate crop-wise and relationship-wise, then maybe an export window opens up a little bit for the U.S. But the other one that's got to be the top of the list then is Southern Hemisphere production. Those crops are just getting very early planted now in Argentina and Australia. Obviously, hot, dry weather there, some poor weather in Southern Hemisphere changes the picture for wheat as you move into the 25-26 crop year. We'll know more on that August, September, October. So it's going to be a few months. They're just planting now. But for the near term, Curt, I think you've got to look at what the Black Sea is. What are the developments? Black Sea, when I say Russia-Ukraine war, I say Russia-Ukraine production. And most importantly, Russia's export intentions for 25. Are they going to become aggressive again? Very aggressive last year, early part of the crop year, and had to tail off as the crop year wore on. But that's the biggest wild card I can see changing, Curt. Domestically, maybe more feeding. There's some challenges. You're far more expert at this than I am out west, with some challenges of feeding hard wheat at a high volume level. Although it does feel like the hard red crop's bigger than what we thought earlier. But that would be another home for hard wheat or for any wheat to find, because it's searching for demand right now. There's no other way to say it. We're making contract lows with the improvement in the hard red crop and worldwide conditions as are. The last thing I'd add, Curt, would be Canada spring wheat crop, as well as our spring wheat crop up in the northern plains. So Russia, Black Sea, crop conditions in the northern plains, Canada, and wheat searching for demand. Maybe the feed surprises us this summer. But those are the things I'd see that could be wild cards that would change the direction near term.
Absolutely. Thank you. Well, to conclude, to each of you, just for fun, and you can be as outlandish as you want to be, but give me one black swan event that could really throw some havoc into the market either direction going into the summer. And Nate, we'll let you go first.
I don't know if you call it a black swan, because I think the trade dynamic, though, is probably the biggest driver in my mind today. So, a similar trade one deal where we see some captive demand out of the U.S. for China trying to meet a dollar figure obligation, something along those lines, and how that would shift and look different versus the previous trade war, right? Two components of that. One, the increase in world supply of corn potentially year over year, and still some upside in that South American crop, like we talked on a good finish. USDA, from the start of this 24-25 marketing year, any increase in Brazil's production has been put back into domestic demand, which I think is justifiable, but it's 11 million metric tons since the May 24 WASDE to see that growth. And while we know that their ethanol production, corn ethanol production, is increasing, probably some domestic feed, they've, I think, increased FSI consumption 10 million metric ton and feed, 500,000. Can they keep doing that if it's a 135 crop? And if they were to see something along those lines, again, different trade dynamic, that black swan, a trade agreement, that's going to displace, I would think, some of this corn demand that's coming to the U.S. Mexico being a big one. Could they be buying some more Brazil corn, some of the recent EU demand? So it feels like a little different trade environment, although, a captive corn market would, I think, be pretty favorable to U.S. prices here, at least short term. And on beans, kind of a similar situation. If we see that increase in U.S. exports, a trade deal, we've got a lot of supply that's available in South America that would have to find a home, some differences versus the previous trade war. If we don't see it domestically, again, not necessarily black swan, maybe I'm not answering your question, but we've increased domestic consumption significantly from the previous trade deal. So, to have a non-export pull off the P&W with a China trade war and them not buying those bushels, there's 300 million bushel capacity, annual capacity, that's been built west of the Mississippi since 1819. So my black swan is something we've seen before, which isn't really a black swan. It's more of a normal event, but I think it's just the tariff situation and how much that could still swing these balance sheets and prices. A lot of volatility with that.
Yep, absolutely. Brian, do you have a different angle?
Boy, I wish I could come up with something other than what Nate said, Curt, but I got to come back to the 800-pound gorilla in the room, and that's the China trade agreement with the U.S. And what I want to bring it to briefly, Curt, is mold that into a risk management thought, and it's both for the end user and for the producer. Obviously, today it appears that the risk, the upside, particularly in corn, would be to the end user from these levels, and that would be, as Nate said, China comes in here and just with the trade agreement maybe buys 6, 8, 10 million tons of U.S. corn, and that 2.6, 2.7 for 25, 26 looks conservative. Maybe it's up to 2.7 or 2.8, and all of a sudden we're looking at unchanged carryout. Maybe the yield is 176. So the end user has to be protect the upside, but give yourself downside. And the producer, it's always there now as far as give yourself a floor, but leave the upside open. Remember, they're two sides of the same coin, and that is giving yourself market flexibility. And if there's ever been a higher level of uncertainty in the markets right now, I don't know when it's been in my career. And when you look at the weather season just starting now, some wet spots, some dry spots, long way to go. But then you got China in the room, and then you add in the Black Sea situation, Curt. But bottom line, I would say the biggest black swan for both an end user and potentially a producer would be either a resolution to the trade situation with China and the U.S. Or the lack of a resolution, and China finds their needed supplies somewhere else. And so you gotta maintain flexibility and maintain protection in your marketing plan, your risk management plan.
Good words, good advice. So thank you, gentlemen. Audience, thank you for tuning in. Our next USDA WASDE report is June the 12th. exactly a month away from today. So please join us after the close that day for the next one of these events. And just a reminder that we have our daily ATI Pro Media every morning at 9 a.m. So thank you and have a good afternoon.